The Commerce Department reported yesterday that Americans are spending less money because they're running out of money. Let me read you the first couple of lines of a Yahoo Finance article reporting this. What they said is that retail sales increased at a slower than expected pace in May as high interest rates and inflation continued to weigh on consumers. Now, you don't have to be a rocket scientist to understand that for the average person, your incomes didn't grow fast enough to keep up with inflation. We have seen a lot of inflation, not just reported inflation, but real inflation, where your groceries are more expensive, your housing is more expensive, your cars are more expensive. And so if your income did not keep up, well, you're effectively poorer today than you were 5 years ago. But if you look around, you'll see that a lot of people have nice things. Like this morning, my cousin texted me, not my broke cousin Bunty, a different cousin. And what he said is that, dude, I got my DoorDash delivered to me today, and the guy that delivered my DoorDash was driving around in a brand new Benz. Now, how are people affording all these nice things if inflation has been so hot, if inflation has been higher than people's wages? Well, in 2023, we saw a big boom in credit-based spending. What that means is we saw a lot of people digging into debt to continue funding their lifestyles. I made a video on this, but Wells Fargo even published a report on their website saying that you have a lot of equity in your homes because home values were booming, that you can use this as an opportunity to pull cash out of your home to continue maintaining your lifestyles because, well, the economy is hard. But this is where now people are starting to face the impacts of the inflation and interest rates, as we're seeing through the data, because people are now finally starting to pull back on their spending. Like in 2023, we saw a record number of hardship withdrawals on people's 401ks. We saw people dig into their savings accounts to maintain their spending. We saw credit card debt boom to a brand new record high to maintain that spending. But the question is that sustainable? Well, it depends who you ask. So the Yahoo Finance article went on to give a statement from Oxford Economics. And here's what they sent to their clients. What they said is that, quote, consumer spending is slowing because real income growth is moderating, and because some consumers are becoming credit constrained, and elevated interest rates and rising credit card utilization are slowing people down. What that means is people were borrowing a lot of money in order to maintain their spending, kind of like what I just talked about. But now, because of the higher interest rates, people are facing higher than expected debt costs. And because people have to spend more and more money paying down their interest, they have less money to go out and spend at Gucci or Chipotle or Sweetgreen. So this is where now they're starting to see the shift in the economy. And then Deutsche Bank also weighed in on this as well. And what they said is that, quote, the consumer is certainly slowing, but at the moment, I don't think it is a worrying trend. I think it's just getting back down to what we think is more of a normal pace of the economy pre-pandemic. So what they're saying at Deutsche Bank is essentially, yeah, the consumer is spending less money, but it's not that big of a deal because it's just kind of going back to what was normal. But the question is there a bigger deal associated with this? Meaning, is there a concern of people spending money less? And this is where it helps to understand how our economic system works. Now, we've talked about this quite a few times on Market Briefs, our free financial newsletter. If you haven't joined Market Briefs yet, I got the link for you down in the description below. But this is where understanding the economic system is so important, because the more money you spend, the more money somebody else makes. Like if you walk into Sweetgreen and you buy a bowl of salad, they make money. If you walk into Chipotle and you order extra guac, they make more money. But if you walk in and then you walk out without buying anything, they don't make money. And if people have less ability to spend, that means they're buying less stuff. And if people are buying less stuff, that means ultimately businesses would be making less money, because that means less money is transferring from the hands of consumers into the hands of businesses. Now, when you have inflation, things become more expensive. And that means people have to pay more money for their rent and their groceries and their cars, which leaves less money left over for discretionary purchases. But we didn't really see an impact of that until really just now, because people were kind of subsidizing spending through debt or through savings or through investments. Like we said just a minute ago, 401k hardship withdrawals were at a record high. People were digging into their savings, and credit card debt also broke a brand new record high. And then we also saw the big boom of buy now, pay later, which we're still seeing today. So 2023 was kind of like the year of people were spending money that they didn't have in order to maintain their lifestyles. 2024 is the first time, just now, we're starting to see people pull back on their spending. We just got the May data, and the data in April also showed us that spending is slowing faster than expected. Now the question is this a worrying trend? And I want to premise this by saying we know that our economy goes through ups and downs. I don't want you to take this as a reason to fear or panic or do all of that. What you want to understand are the trends. That way you can find investment opportunities, and that way you can be prepared for yourself, because the reality is the economy goes through ups and downs. But if people have been racking up a lot of debt, like we've been seeing happen with credit card debt, we're also understanding that credit card debt is a variable interest rate debt. That means the amount of interest you pay doesn't just depend on how much you owe, but it also depends on what the interest rates are. Well, interest rates are a whole lot more expensive today, and people are hoping that the Fed will start cutting interest rates so your credit card debt becomes more affordable to pay off. Well, the Federal Reserve Bank has now said in their most recent meeting that they are not looking at making interest rate cuts right now, and they might make one interest rate cut in 2024. Now, earlier, we thought that the Federal Reserve Bank was going to cut interest rates 6 times in 2024, according to what they were saying. Now they brought it down to 1 time, and we'll see what actually happens. But this is where understanding that there's a lot of outstanding debt out there in the hands of people and also in the hands of corporations. People have some variable interest rate debts, like credit card debts. Corporations have a lot of variable interest rate debts. Most corporate debt is some sort of variable interest rate debt. Most commercial landlords only have variable interest rate debts. And 2024 is when we start to see these debts readjust. We are expecting to see more debts readjust in 2025. And this is where now, if we start to paint the whole picture together, our economic system runs on spending. And if more and more people have to spend more money to pay off their debt and interest, there's less money to spend in other parts of the economy. If people have less money to spend in other parts of the economy to buy Chipotle, to eat at restaurants, to go on vacations, to do other nice things, because they have to buy their necessary expenses and then pay off their debt, that means that could signal a slowdown in the economy. Notice how I'm saying this very cautiously, because I want you to understand kind of the impacts of all of this. But of course, only time will tell, because we have a couple X factors. Number one is we could see changes by the Federal Reserve Bank. Obviously, 2024 is an election year, which could entice them to potentially cut interest rates to stimulate the economy, because nobody wants to see a slowing economy. And then we also have the X factor of what could the government potentially do to stimulate the economy. Before, a government would not get involved because the economy is separate from what the government does. But now what we've seen happen, especially after the 2020 pandemic and the 2008 crash, is the government has been getting more involved when you see these types of downturns. So it's hard to kind of predict what will happen because of those things, but this is where I want you to understand that the financially educated investors, what a smart investor would do is, number one, be prepared. That means you have cash to protect you against a downturn, because in case something happens to your job, something happens to your business, you have cash to fall back on. Number two is you're financially educated. You know how to find a good investment. You know how to analyze an investment. And number three is you understand and can dissect financial trends. You're understanding what are the changes in spending habits? What are the changes in business? What are the changes in money? That way you can find an investment opportunity. But this requires you, again, going back to number one, to be prepared. Because you can see a great investment opportunity, but if you don't have any cash to actually go out and capitalize on it, it doesn't do you any good. And what we're seeing right now is we're finally getting the data showing that people are starting to pull back. We kind of talked about this a lot in 2023, which is that if people keep racking up more and more debt, eventually you'd think that people would have to hit a breaking point, which is, okay, inflation is there, but I'm going to keep spending money regardless. We saw this happen a lot in 2023, that despite the high inflation, I'm going to keep buying the nice cars. Despite the high inflation, I'm going to keep going on the vacations. Despite the high inflation, I'm going to keep living this expensive lifestyle, partially subsidized through debt, which isn't a problem until it becomes a problem. And you can start to see where if people are then pulling back on spending, well, it could be because people are starting to face the impacts of, okay, I overspent in 2023, I overspent in 2024, and now I got to spend more money paying down my debt. And so this is where I want you to understand the different trends that are happening in spending. Obviously, we keep you updated on market briefs, but I want you to understand the trends of what's happening in the economy, the trends of what's happening with spending, the trends of what's happening with inflation, the trends of what's happening with the Federal Reserve Bank. That way you can be a more educated investor and find the opportunity instead of being one of the people that gets blindsided, instead of being one of the people that starts to panic, instead of being one of the people that just chases the emotion, because then you end up being the person that just makes everybody else rich because you buy high and you sell low. But I want you to be the person that knows how to find the opportunity, that doesn't get blindsided, and can stay calm when things go crazy, because that's where the real opportunity is. But that requires you to understand the trends and pay attention to what's happening when it's happening.